What's up, Mortgage Coach community? Dave Savage sitting down with Bill Dallas. What's up, Bill?
How you doing, buddy?
I'm good, man. I am really looking forward to this conversation. It is the first time I think I've ever interviewed you or had a conversation like this where you were not CEO, founder, chairman, president of a mortgage platform.
Yeah, that's sort of interesting, isn't it? It's like I don't know whether I'm going to act any different or not. We'll have to see.
Yeah, like I'm looking forward to it. So here's the deal. I am, while I've been doing this for over 30 years, I've never seen a shift like this one where there's some, usually when there's a shift like this, it's just bad. It's like, cover the hatches, everybody, some are dying, some are living, but there's not usually a lot of great opportunities. Whereas this is a market where there's some bright lights and it's massive shift, and everybody has to right size their platforms, whether you're a loan officer or you're a leader. But I'm writing this article with Kristen Messerly. It's called the 2022 State of the Mortgage Industry Halftime Report. Because while it's May 31st today, it's halftime tomorrow. It's halftime today. So I want to have a similar conversation with you that I'm having with others. And I want to start it with, what are the data points, the 3 data points that you think have changed the most that set the table for what we need to do to thrive in this market?
Yeah, I'm going to forget interest rates and just the shift that we've all known has happened, right? Which I think are meaningful. The Fed shift, that we had this conversation for so long that I think for some people it was sort of anticlimactic when it hit, but when it hit, it was so terrible to most in terms of just the overall shift that I think it really, I would say the first half of this year, it really freaked people out. So when I look and I do some reflection, right, I would probably say if I took 3 data points, I'd say first, while volumes may drop, and they are dropping as a result, they remain historically high with strong refinancing and purchases, right? So I think the first data point is that if you look at it in a continuum, it's still going to be a really good year for mortgage. And so I think people have a tendency to, focus on the glass half empty instead of full. I think the other data point is with, there's a lot of juice in the refinance boom to squeeze.
Right.
A lot, right? Because as Black Knights reported, there's a whole bunch of homeowners with a lot of equity, and it's historic equity. So that would be 2. And then I think 3, something's got to give with volumes down and large players committing to gaining market share and profit margins compressing. So you're getting the squeeze, right? So you've got this big squeeze going on, and maybe you feel it, maybe you don't. I'd say you feel it because, if companies have laid off a lot of people as a result. So those 3, let's stay with those 3.
Okay, so let's summarize. So production is still historically high. I think, we still feel pretty confident it's going to be the 3rd best year in a decade or more. We have historically high equity, so people are not forced to sell. Like usually in markets, people are forced to sell, and there's low inventory, so values are going to stay high. And then net out number 3, just a little bit more.
3 is now the margin. I would say, if you just said a couple words, margin compression. Something's got to give, right? Volumes down, and people have committed lots of capital and people and channels and things to growing and trying to get market share. And profit margins are going to continue to compress as a result, because there's still a lot of overcapacity. So something's got to give.
So, and just one call out, guys, anyone listening to this, whether you're a leader, you're a branch manager, you're an originator, some loan officers are more profitable than others. And that's like the understatement of the century. Like it's amazing how some loan officers, they're pricing the same, and they have single digit price exceptions in terms of the basis points they're costing the company. And some loan officers are like 5x, they're
Mhm.
cost the company 50 basis points and thing. And so I think it's, we'll get to this. It's never been more important that you're upgrading how people sell. They're selling value, and you're upgrading how managers manage salespeople, because you don't need to be as unprofitable as you are. If you just really focused on, best practices from your best, most profitable, and how do we, and we got to upgrade the team fast. So I just want to get to
For
that.
sure.
Now, what are three trends? Like when you think of three
Mm.
trends that are impacting the market and that kind of get to your opportunities, you got this data, you got these
Yeah.
trends to get these
Yeah.
opportunities. What are three trends that you see?
So I'd say probably three that are consistent, right? With the shifts in the competitive structure of the market will continue. So what is the structure that's shifting? I think the number one thing is the shift to independent mortgage banks from banks, right? And that shift has been going on for a while, right? You and I have lived through it, Dave. And I used to actually, there's an article that was written years ago on that once somebody gets a 70% market share, shit happens and somebody else takes their seat. So banks have it, then savings and loans had it, and independent mortgage banks had it, and then they just keep shifting. So the shift is occurring, and it's moving to non-bank origination and non-bank servicing, which should be good for mortgage, just in general. Shift number one. I think the shift number two is I think the borrower's expectations of what I'm going to call a multi-channel world will continue. I'm going to call it what I think a lot of people call it, omni-channel.
Right.
Instead of having, so if I'm a customer, I don't really care if you're a broker, a loan officer, or I'm sitting in a call center. I need you to help me. So somehow this, and that sort of combines the moving to a digital world with meeting the customer. I've always said my tagline has always been, hey, let's just meet the customer where and how they roll. And I think this is really been accelerated and will continue to accelerate as a result of what happened with COVID.
Right.
Like, look at us, right? We used to do a lot of things together. We were at events. Now we're doing a lot of stuff over Zoom, more social media. All of that's going to continue. I think the other piece of that in a multi-channel world is I sort of want it the way I want it, but I'm going to want some human intervention at some point in the process, right? Because it's too important a decision for me, whether I'm buying a home or refinancing, or I'm just considering what my options are. So that I think is two. And then I think three, reliance on what I'm going to call partnerships and talent. And I've never seen anything like it, right? Will increase. So the need for different talent and different people to power what you're doing is a transformation that's slowly evolving. And I think what you're seeing is that people that control the lead source win. And people that don't are left to the vagaries of the market. So I think when you look at things that are from a partnership perspective, things that are working, and you hear more words of affinity, partnership, getting back to basics. I mean, all the things that you sort of hear about, but I think the reliance on really new channels, partnerships, new talent are gonna shift and change. And those three things I think are pretty consistent.
Yeah, no, I could not agree more. And we'll unpack that in a little bit. And so what do you see as the three biggest opportunities, whether it's a C-suite opportunity or it's a local, IMB loan officer? What are the three biggest opportunities in your mind?
I think I think this is, and I'm going to start with the nimble and the small. The biggest opportunity is, and let's use sports franchises or somebody like that, right? If you are suddenly the Milwaukee Brewers and you don't have a lot of money, and you have to revamp it because you're a small market team, this is your time to shine, right? So if you can be nimble and you don't lose money, you can do anything you want right now if you're focused on what that is. So one, I think I always said DLM is my number one structure. Don't lose money. And if you do that, all these opportunities open up for you. I think the things that are, I'm going to say probably the biggest opportunity shift, and we can throw it into one if you want, right, would be the use of data. And looking at your shirt, right? No borrower left behind. So I think the number one thing that is really messed up in mortgage, and it's going to fix itself, is retaining the customer relationship. And we've so talked about it until it's ad nauseum in the industry. But at the end of the day, data, technology, and focus is beginning to really change that landscape with triggers and different things. So I know what my borrower's doing. And what hasn't changed really is I think the mindset of a lot of loan officers and a lot of companies, their focus on new originations versus their focus on retaining the customer. And that's got a lot to unpack, right? Because we're paid to do one thing today, which is originate a new loan. And unfortunately, we should be paid just as much to retain the customer relationship. And that can't just be in servicing. And then I think the final piece will be product. And there'll be a massive change in the structure of the product that the consumer wants and the one that the product that we just gave them. So a 30-year fixed rate loan will give way to something else.
Really? Like what?
I think more of a loan that's more borrower centric, a loan that flexes with the consumer as their loan. I mean, look, like you and I have talked before, you can't have a 30-year loan and investors, borrowers. So borrowers refinance it every 12 to 18 months and investors have the thing prepay every 12 to 18 months. So why do I have a 30-year loan? Well, it's the safest loan. It's what my grandpa got. It's what everybody told me I should get. Well, at the end of the day, it should be portable. It should be flexible. It should allow me to have access to my equity and things. If you were really customer centric, then what you would do is give me a loan that stays with me and you over a long period of time. And I think that's going to begin to bear itself out, especially as yields go up. When yields were low, right? All the government came in, they basically saved us, and they said, here, here's the lowest rates in the history of mankind, right? We've never seen them, and we all availed ourselves on them. And now but it's not the best. I don't think it's the best product per se for a person that owns a property. It doesn't make a whole lot of sense to keep going in and out. Oh, it's no cost, no fee. That's not true. There's a bunch of costs and a bunch of fees every time you do it.
Yeah, I think that'll be interesting to see. I'm excited about it. So far, this is my third or fourth interview with just people that I think are change agents in the industry, ranging from C-suite leaders to CEOs of clients to, leaders of the top media companies. And so far, no one has proved me wrong that the biggest shift that whether you're a loan officer or you're the leader of a company it's data. It's growing your database. So like some lenders are implementing strategies and some loan officers are implementing strategy where they're actually growing their database. They're making the case with realtors that I have this fintech powered platform, Salesforce, or whatever, not Salesforce, but CRM. So the best CRM is the one that integrates with Mortgage Coach, but a CRM that's powered by Sales Boomerang. So we have borrower intelligence that creates digital presentations that educate families. And if you, in technologies like HomeBot, that if you give me your database, I'll make it more valuable for you. And they're growing the database and they're improving the retention. So tell me if you, and I kind of know you aligned with this. I don't know if I've ever shared this acronym with you. Have I ever?
Yeah.
Okay, so you've heard this conversation that I've delivered, and for anyone listen to it, guys, this is what the retailers, where their stock is up and their future is bright, that stands for what Amazon can't do. They've done it. And guys, we're in housing. So the mortgage and real estate professionals that have local loan officers and they're doing what Amazon and Zillow can't do, you guys are going to kill it this decade. But the thing is, you need to do what they can do as well. So borrower intelligence is what they can do. And I know because, now Mortgage Coach and Sales Boomerang are together. And so we know that realtors' databases look like this. And most loan officers, your database looks like this. And we know that Rocket's database looks like this. And Zillow's database looks like this. They know who's most likely to move up, move down, be ready to transact. And so guys, this is what you need to do. You need to make sure that not only do you have the borrower intelligence and know who's going to transact, you need to be able to deliver a presentation, whether it's automated, the machine is creating this, or whether it's augmented, where, machine is creating the first version, and then the loan officer has this digital presentation where they can deliver advice, not price. What are your thoughts on that as
I love that.
a massive opportunity in today's market?
Yeah, I mean, I would call, I always look at things and I love the tagline, right? And I think when you're thinking long-term with your customer, you've got to basically, I've always said, the move from an LO, the loan officer, broker, to an advisor, to a person that provides SLA, stays connected to the customer is a big move. You could do it contractually, right? You don't have to just get paid on the mortgage itself. You could get paid to do services, and
Right.
you just have to list what those services are. And I actually think I call it optimizing sales, right? Through really a focus on analytics driven retention, right? Which is, I think, what you're talking about. So if you're an LO today and you pivot to purchase, which is big, and relationships, and you focus on these analytics, right? I think then you begin to optimize the customer relationship, and you got to have more products and more services. The challenge for loan officers really is the void between the purchase or the refinance and the next deal.
Right.
Right. And so I've always, like you, stayed focused on how can I reimagine and lever that relationship in a way that you, the loan officer, can optimize this borrower, right? Your tagline, no borrower left behind, is a good one, right? Because you really want to, it is military, right? You don't want to leave them in the battlefield. And we go back and get everybody we can. And I think so I stay focused on trying to figure out products and services that allow us to stay connected, right? In that void, in that period of what did Dave Matthews song, it's the space in between. And it's a tough space, right? If you've got this void that exists, and if you're a bank or you have something where there's some repetitive, whether you have a credit card or something like that, there's a constant use. So how do we stay connected? And yet we do a whole bunch of things to not, right? We sell your servicing. You don't really know who we are. We don't call you. We're busy with our new originations. So we don't focus on it. And there's a lot, I think, Dave, to unpack in that for companies that are really serious about it, because you've got to really look at my contracts, my agreements with my loan officers, how my loan officers get paid, how I store data, what we want them to do on an ongoing basis. I mean, we all want them to go out right now and get new customers. Is that the best use? Shouldn't you go back in first and look at all your existing customers? and see what they want to do, because they have so much equity and so much. I mean, that would be the lowest hanging fruit.
Yeah. So I don't know if you ever, in any of your, C-suite opportunities, you ran the numbers on this, but I saw a presentation a couple of years from, I think it was the CEO of Rocket. I mean, he was number one, number two, top executive there. And he said, he asked the audience, we've analyzed what our number one line item is where we're losing money, our number one expense. And, everybody's like, loan officer comp. And no, marketing, no, tech, no, lost loans.
Lost customer.
Well, lost loans. He's like,
Yeah.
we lose a lot of loans where the loan officer turned it down and we could have funded it if it was looked at properly. We lose a lot of loans where they qualified, but we didn't convert them, like they went somewhere else. We lose a lot of loans because they don't do their next loan with us. And he's like, the number one cost of doing business is the lost loans. And it's kind of funny. Like, first of all, do you agree that that's probably just every lender in America? That is the number one cost of doing business?
Think about, that sort of triggered just my own view of how your P&L is orchestrated today, right? You have pull through adjusted locks. Almost every company in America that's in mortgage doesn't look at fundings anymore. It looks at locks. And that's the top line revenue item. What's the first thing you do when you look at that top line revenue? You take 20% of it off. So app to lock, there's a 20% void. So what if you just you spent money on, you invested in 100% of these loans, 20% of them didn't even lock with you and are now vapor or gone or somewhere. Focus on that.
Yeah,
right.
Lost loans.
Lost loans, really, and that's probably Emerson or Farner. The whole crew. Yeah, the whole crew really. I mean, I love the way they think, because it is customer focused, but it's so simple. Right. The one thing that they do have at Rocket, which I think is we've got to try to figure out, and they've now spent the last decade trying to, is just other products.
Right.
And other services.
Yeah, no doubt that is an opportunity. Well, hey, anyone listen to this, if you're a loan officer, if you make sure that everyone that's in process, you're asking for referrals in a strategic way. Jeremy Forcier has taught us a great script that when someone says thank you, which is usually when they get approved or they get clear to close, can you help me? I'm looking for more people that can help me and that I want to do business with. And you ask for a referral at the right time. Make sure that you're doing annual reviews. Make sure that you've got a borrower intelligence platform like Sales Boomerang. If you just made your customer database your number one priority, like I literally think if you made that your number one priority, first of all, you're going to be more attractive to realtors. You're going to be able to get realtors to give you their database. You're going to grow your database and you're going to win. Like, would you agree? Like, number one priority is stop losing loans and start delivering.
Stop losing them. And like, I think with Jeremy, when I was a loan officer at First Franklin, when I started my first business, I showed up at every closing and I gave the customer, now it would be probably highly non-compliant, but I gave the customer, if you gave me three names at closing, I reduced your closing cost by $300, $100 a name. All you had to do was provide me 3 customers. Thank you very much. Now it can't be Batman, Robin, and Catwoman. It has to be 3 actual names. And it worked. I mean, I grew my entire database of people just by, when I closed, I showed up, I asked for 3 more, and off I went, right? I think there's easy ways to stay connected, but Jeremy's right? You have to, the business is not that difficult, but you're always, and the lowest hanging fruit are always people that are really, that you just helped, right? Because they will offer other friends and neighbors and folks to be, and everybody wants and they don't need to be paid for it. There doesn't have to be a reward system, and people just want to do it because they want to be helpful to you.
Yeah. Well, first of all, if you've delivered not just, great 5-star experience, but you've delivered tangible advice and value, that's where a total cost analysis comes in, where, there's value in that service, in addition to just delivering a great experience, guys. So anyone listen to this, grow your database is my takeaway. Don't lose customers. Omni-channel, make sure that you're auditing. Are you communicating with people the way they want to be communicated? Don't lose money. And guys, for loan officers watching this, maybe you need to right size your life. Like I can think of changes in the market where I didn't execute that as quick as I could have. So, make sure we're not losing money. I love it. Any closing thoughts? Anything you want to make sure you share before we wrap this up?
I think maybe the biggest future, how if I took the two wild cards, I would guess in the industry, and what I think might be the two things that the future of work, which we didn't talk about, right? If I took whenever I work with a CEO, I always go through the 7 priorities of things I think are really important to run a good mortgage company. And then I always say today, there's probably 2 wild cards. One, the future of work. Where are you going to work? Are you going to work from a branch? You're going to work from home? You're going to do all the above? How are you going to do that? Right. And I think companies are still trying to figure that out. So understanding your competitive advantage and how you're going to do it is one. The second one is affordability and racial equity. It's going between DEI and ESG, diversity, equity, and inclusion, and environment and social governance. Those 2 things are going to radically change what you do and your priority, much like HMDA did years ago, right? And just looking at HMDA data, we are now going to start looking at carbon footprints. We're going to look at racial equity inside the organization, boardrooms, and we're going to start measuring, and allowing for affordability and other issues so that we make sure that we are balanced in the way we do things, right? And I think it's a 2-edged thing. And so those 2 things, I think, Dave, would be sort of wild cards.
Yeah, I'm also with Kristen. We're writing this, this halftime report, but we're also writing something we're calling the Millennial Housing Gap. And this was some data that was shared by Todd Bellinger in our Facebook group last week. And, it reads that in 1990, baby boomers turning 35 owned 34% of all real estate value in US. And in 2019, millennials turning the age of 31. So it's a little skewed to make a point. Well, it's very skewed to make a point, but still 4% of all real estate. I mean, that's clearly, one, not sustainable. And, I don't care what side of the curve you're on, that's not sustainable. And I'm making the case to the industry that, guys, there is a financial literacy crisis in America. And you need to raise the bar on a pre-qual. Like, instead of just qualifying someone for a transaction, every consumer at the point of sale needs to get a rent versus own analysis. They need to understand, based on their vocation, what they do, how much money they make, what market they live in, what their goals are. They need to understand the economics of home ownership. And while home ownership is lifestyle, like that is, your status, that is your lifestyle, that is all of these things, it's also your biggest investment. And I think that it's our job in the industry to make sure people can manage their equity appropriately, make sure they manage their liabilities appropriately. And I have this thesis that if the mortgage industry just started, like, not just doing a pre-qual, but doing a rent versus own, like we could change how people think. And what if the mortgage coach community and loan officers started going and volunteering times at high schools and colleges and teaching, renting versus owning, teaching how to manage your debt. Like, we could really change the narrative if we did that. I mean, what are your thoughts on that?
No, at Oaks, I have a high school that we do that, right? Where we go from 5 to 12, 5th grade to 12th grade. And we basically have transformed our thinking around that so that I'll take it another level. right? Not only do we do basic balancing of checkbook and balancing of budget and budgeting and the importance of home ownership and credit and all those things, we also uh, work with local nonprofits to understand down payment assistance, but we also understand the homelessness. And we bring in homeless and we let our students see people who are homeless and how important having a place to live really is. The question is, are you going to rent it or are you going to own it? But you got to have it because you can't be homeless.
Right.
And so, and it's your job as an American to bring all these people to homes, right? It builds community, it builds sense of community, and all of that is important to the ethos of a student. And I was going to say that probably where you were going with it, and what we see is this group, this millennial group, the shift is in convenience and sharing, right? Whether it's Uber, swiping left, swiping right. I mean, they're delaying owning, they're delaying marriage, they're delaying childbirth, they're delaying everything, right? And part of that was because of 2006 and 2008. Part of it is, what they've seen. Part of it is COVID. But at the end of the day, it is a large number of people who are now, I think, needing to be not sold, but convinced.
Educated.
This is a
Convinced.
big deal. Yeah,
Right.
because all my kids, I have 3 millennials and 2 Gen X, Gen Y. And so the number one thing that my wife, Bev, and I, that we work on with our children, and we did a lot of it through COVID, was owning a home. They all own real estate. And it's important for them. And they become, it floods. Yeah, when it rains, the shit happens. Yeah, you got to clean out the acorns when the acorn tree drops them all. Yeah, you got to blow off the snow. Yeah, it's not pretty at times. But at the end of the day, what they do get is the tax benefit. They do understand in almost every case, we teach them to rent a portion of their home to pay for their payment. So they basically got the best of all worlds. And so I think you're right, Dave. I think the transforming, maybe what we have to do is we have to reimagine this for this generation and sell it in a much better way, because it used to be that it was just enough that you're in America. It's almost a constitutional right to own a home. You should own one, and everybody, that was passed down from family to family, right? And today, I think it's much more confused than that. So it seems like we have to do a better job of saying, this is the why, right?
Yeah.
And everybody wants purpose-driven. Why should you do it? Because if you don't do it, first of all, you will not retire on time. You will not have equity that's available to you. And there's a way to do it over your lifetime, and there's an order in which you should do it. And if you follow this proven path, right, here's where you end up versus
financial freedom.
Don't.
Exactly. It is a cornerstone to financial freedom. And, anyone listening to this, stay tuned sometime. I know it's going to take us at least a week to finish the interviews and write this. So by June 15th, somewhere between the 8th and the 15th, we will publish this on social media. It'll be.
I can't wait to see it.
Yeah. And Bill, I really appreciate you making time.
No, thank you.
If anyone wants to follow you, because I know you're doing some, consulting in the C-suite. To me, you're just a great leader in the industry. I like following you on social media. What's the best place for
best way is
Bill
at dallascap.com. And Dallas Capital, you can go on my website, which is Dallas Capital, and sort of see. I've sort of rebranded it so people could see it from before. I have a family office itself for my own management of worth and everything else. But at the end of the day, you'll get a sort of a sense and feel for what I think is really important in the world today, which I think is community and helping others.
Yeah,
right?
well, hey,
and being able to do that.
Well, dude, you've been a mentor of mine for multiple decades. I still remember when you were, I think it was a broker back in the first Franklin days, and you had some of your best customers, which I was, blessed to be one of, out to your house. You did a multi-day kind of voice of customer, 2-day workshop. I think we played golf half a day, but I remember how present you were, how committed you were to getting voice of customer. And that's another thing, guys. You helped grow that in me, and I've built my career in mortgage coach. Like, no one is closer to the customer, loan officers, than me. No one's going to outwork me, and I'm going to make sure that I know this customer that I serve. And thank you for that, brother. And I also think that's a reminder for everyone watching this. Guys, the world's changing, the customer is changing, and you need to know your customer, and you need to implement business practices around that. So, brother, take care, man.
You too, man. You too. Proud of you.
Yeah, appreciate you. And guys, give this a like if you got value. Share it with your mortgage friends and your executive team. Thank you, Bill. Take care, everybody.
You too, man.